All right, good evening, guys. Ken at Tortoise Capital. This is the Foundation's Q&A session for, let's see, 2023-07-13. So we'll just do a quick check-in here in a second. I'll start off. My brother drove down. We had an enormous purge of the office, so I ended up donating about 4 carloads of professional books that have accumulated over the last 35 years. And he took home about 100 war games and about 40 drums and percussion instruments. So my home office is in a shambles, but I can actually see the floor and walls for the first time in a decade. So it felt a little weird, to be honest. I tried to use the Marie Kondo approach of touching something, and if it didn't spark joy, then to get rid of it. I tried to use the principle of uh, better that I dispose of these things now than dying and having my kids, try to figure out what to do with this mess.
But Ken, that actually sounds like an episode of Hoarders.
Yeah, it kind of does. It kind of is. I'm not that bad. There was, I mean, unlike maybe hoarders, I read every book that I donated, and I played every war game that I donated, and I played every drum. And you know, in some cases, I had moved on from those topics, and I hadn't read them for a while. But everything that I donated was something that I used. So, although I had a lot of stuff, I don't consider it to be hoarding. But then that's what a hoarder would say, wouldn't it? But I would, yeah, better to dispose of it properly, I suppose. So, Lou, how are you doing?
Good, thanks. If we have some time, I do have a couple questions for you.
Yeah, go ahead, send them to me. Just give them to me real quick, so I can
Oh,
jot them down.
okay. So, just verbally, or you want me to send it to you in an email?
No, just give it to me verbally. I'll get them.
So one was I found out in the video, what OR means, but in a couple of the nightly strategy calls, you use the term OR3. I was hoping if you could spend a moment on that.
Sure.
Got a question on the time scale, just day trading versus swing trading, the 3 minute versus the 30 minute, and then managing the trade, staying in the same time frame or switching. Those were the two I think for that I really had from off the top of the cuff, kind of.
Okay. Anybody else?
Ken, if you could just have a couple of minutes on just self-coaching, maybe, I'd really appreciate that. But you've answered a lot of my questions, so I'm sure someone else might have one.
Okay. Chin Long or Damien or Greg?
Yeah, I'm okay.
No, we're good.
Okay. Chin Long?
I'm okay. No
Okay.
question.
Greg?
I'm good. Go ahead, please.
Okay. Let me go first things first and talk about the OR. OR just means opening range. So there's actually a set of researches about this. There's the opening range 60 minutes, which is going to lead us towards the frog system. There's the OR5, which was a separate system, and it had to do strictly kind of with day trading. The first one I came across, and then I'll talk about the OR3 as sort of my method. So the idea of this is that when the market closes in equities, there is some, there's what is it, about 16.5 hours of news while the market is closed, and then it's going to open at some area, and if this is kind of related to the gap too. So I'll just cover all that. So the theory of the gap is that if there's how much news is there? If there's a little or there's a lot. If there's little to no news, we would expect to see the market open where it closed because there's no new information to process. But as you start getting more and more news of any type, it's likely that in this period of time, guys may be making moves in the aftermarket or in the dark market or in instruments that are correlated to the market. And so especially like the S&P, if there's some kind of broad market news like, oh, surprise oil shock or geopolitical news of some type, then all that information's got to get processed starting in the aftermarket in the futures. And then whatever that price is that closed out the nightly session is where that new price is going to open. And we know that the size of the gap, regardless of direction, is predictive of the size of the follow-through. So there's 4 things that can happen. If this is where it closed, it can open above or open below. If it opens right exactly, we just say it's an upward gap of 0. And then if it gaps up, then there's 2 things that it can do at the close. One of them is it can close exactly where it opened, and that is an upward follow-through of magnitude 0. Right? So it could gap up and close higher. It could gap up and close lower than the open. It could gap down and close higher. It could gap down and close lower. So those are really 4 conditions. And what remains constant is that it is the magnitude or the size of the gap, the absolute value of the size of the gap, which predicts the absolute value of the size of the follow-through, but it does not predict direction. And we know that because on the daily report, when I track that, you can see all of those 4 categories reflected. And you can actually see the trends changing. There are times when 20 times out of 30 that the market is gapped up, it has closed higher. But then 3 weeks later, those gaps up are closing lower. So you tell me, what is the right scientific method to do? Well, there's only the most recent trend of the last 10, 20, 30 days. And so we track that on a 30-day basis and a 200-day basis just to kind of see where the market is in terms of most recent trends. But the one thing that has remained persistent is that the larger the move, or the larger the gap, the larger the follow-through the next day. And I should also say the larger the travel distance. And by travel distance, I mean if it opened here and then closed there, it might have been a straight line, but it might have been a move up, followed by a big move down, followed by a big move into the close. And so you would always have 0 follow through, but the travel distance could be large. So that's really what I like, is that the bigger the gap, whether it's up or down, the bigger the follow through and the utility of the day trade. And it's simply because there's a lot of information that has to be processed about the news, and then the action to change positions or adjust a position, that action leads to reactions and momentum. And so it just triggers a lot of algorithmic systems. And so if you're a day trader, what you need is volatility, because you need the energy of movement, which gets me to find the movers. You got to find the movers. One of the ways that you can find the movers is simply have a list of your 50 or 60 symbols on the watch list, and then simply rank them 1 to n on the basis of the absolute value of the gap. Now, my personal favorite is to just go to the 0 line, and I prefer things that have the largest negative gap, only because that has a lot of fear, whereas the upside has greed. But I will take trades off of either end of the stack. I always think of that as the stack. And so all this crap in the middle is just kind of muddling around. The real value comes from things that have had an extraordinary upward gap or an extraordinary lower gap. So,
Okay.
so that sort of is the baseline. So now what I want to talk about is once we've identified those things that are potential movers, what can we do with that information? Now, was there a question in there before I get?
I just wanted to validate one thing that you said, Ken. I think I wrote down the
Yep.
larger the gap, the larger the follow through the next day.
Yes.
So if the gap is today on day 0, you're saying that day, so tomorrow would be the follow through day?
No, this is what I mean. So let me clean this off here a little bit.
I got it. So that means you're talking about today would be that day.
Yeah.
Okay.
Yeah. So this is strictly the intraday trade.
Gotcha.
The gap is more important the shorter your time frame. The longer your time frame, the more the market is a weighing machine and less of a voting machine. So just to be clear, this was on day -1. It opened, it hit the high, the low, and then the close. And then on day 0, what we're interested in is where that thing gaps.
Got it.
So on day 0 today, I just want to know where that is. So the way I compute that then is I just draw that line straight across. Any open below yesterday's close is a negative gap of some magnitude. And then any open that's higher than yesterday's close is an upward gap of some magnitude. So you take the size of the gap, divide it by price, and you get a gap percentage. So that's the number that you want, because by looking at the gap as a percentage of price, you can now compare that against other symbols today, and you can also compare that to its historical gap over time, and that normalizes it against the price. So you always want to do like gap percentages or range percentages so that you can make proper time series analysis. So as soon as I know what the size of the gap percentage is, a plus 5% price gap has the same meaning as a minus 5% price gap in terms of from wherever it opened. If it opened, the follow-through I define as where did it close. So I'll go out here to wherever it closed today. So if it gapped up, it can either close higher or it can close lower. And so the size of the follow-through is from where it closed compared to where it opened. So that's a percentage. And then if it closed above, then that's a percentage. So the size of the follow-through is simply what was the maximum, or what was the size of the excursion by the end of the day Not the maximum favorable, by the way, but what was the difference in price? This is really the real body of the candle, right? Because if you look at this as a candle, if it gapped up to here and then closed there, the size of the candle, real body, is the follow through from the open to the close. If that was a solid down bar, then it was from the open to the close. That's the part of the move that is available, from open to close is what's available for the trader. So if I have a big gap day, then it stands to reason that I have more volatility to play with all during the day. Now, sometimes it goes straight up, sometimes it goes straight down, other times it moves around. So now we've got to combine the information of the gap with this opening range. So the theory of this goes something like this. There's got to be a better way to do that. Yeah. All right. So the idea is that from the open, there is some period of time in which all the market makers are trying to do is clear the deck or clear the floor. And that is all of the orders that were stacked up as a consequence of the overnight trade have to get cleared. Well, if there's a lot of overnight news, then there's going to be a lot of orders to clear right at the beginning, and there's going to be it starts off with a big gap move, and then that's going to trigger some follow-on intraday trading and momentum strategies. So it stands to reason that the larger the gap, the more gyrations I'm going to find in that first opening range, whatever size that is. Check or hold? But generally speaking, the bigger the gap, the more movement there's going to be in here. So if I can be nimble, then I may be able to do something with that. So now I want you to just to hold that. Now, if there's no difference and no news, and I start off exactly where I closed, the very absence of a gap now establishes this as business as normal. And now if I can put a tight bracket around that, then what I'm actually getting is a movement away from the previous normal. And so I'm able to actually, with a very tight risk box, maybe start engaging right from the opening bell of that earliest move. So the absence of a gap is as interesting to me as the size of an large gap in either direction. So I think of the volatility of the gap as the same way I think of the volatility in general over some look back period. That if I take the average volatility that I'm concerned with, and I call plus or minus one standard deviation normal, there's no new information, no new exceptional information. What I really care about is very small gaps or volatility and very large gaps or volatility, because the large volatility tells me it's already in play. Like I don't even have to wait for the action to start, right? The waves at the beach are already crashing. So it's game on. Now the abnormally quiet is I'm sitting next to a still pond at night and everything is so quiet that any noise is magnified. And so if some guy comes along and throws a little pebble into the pool, that starts filling the space with noise and waves, and it attracts attention simply because it was so quiet. Now, if a move of this size had happened in the middle of the day, we wouldn't even notice it because it's already noisy. But if it happens early and there was no gap, then that actually triggers. This is also the same logic that gets us to, if we have a sideways quiet channel, which we do not trade, and then that becomes a Z3 pinch, which we do trade, because that is, the Z3 lines have pinched to less than a frog box. And if that becomes a super pinch, which we also trade, because now I have the 4 regression lines have all moved inside of that tight box as well. Now what I have is the absolute absence of volatility, and now the moves that start emerging from that are postured to have the biggest run, because everybody is surprised, they get startled, the first momentum guys come in, then the second and the third, then the anti-momentum, and now it's game on, and the popcorn started popping. So in my experience, what we want to be open to opportunities that are at the quiet end of volatility, as well as the already in play large volatility, because those are the exceptional cases from which exceptional moves occur. So now we're primed with volatility, and now we can start thinking about what to do with, let's see here. I can get this eraser. With the opening range. Okay, so the first idea comes from studies of equities and commodities, which I then independently validated, and it has to do with the opening range 60. And the idea was that, you know, you have, 7.5 hours, I think? 6.5 hours. So you have 13, oops, I just lost my pen. There we go. So you have 13 30-minute sessions. And we know that the first 30 minutes can be quite volatile as they're processing the opening orders. And then the last 30 minutes can be quite volatile because all the intraday traders with leverage are unwinding their leverage. And so if they were long with leverage, now suddenly they are motivated sellers, and you get some kind of thing that we call the VWAP magnet, in which price may have pulled away to a very strong move intraday, so strong that it pulled away from the volume weighted average price. And now as these guys that are all holding winning leverage positions now suddenly have to start selling, in that last 30 minutes, it's not unusual to see that price quickly collapse and come down, to the VWAP, and you get this, we call that the VWAP magnet trade. It's an opportunity trade, just fun to do. The larger the move away from the VWAP, the more decisive the move was, and the larger the possibility of this reversion to the main trade. So you'll see that quite a bit. We actually measure that in the indicator called the fade stat, which compares the distance from the high of the day to the close, and make that as a percentage. So really, from the open to the low of the day, we call that the fail stat. And that simply says how far, on average, has that thing fallen to the low of the day. And then from the low of the day to the high of the day gives you the range. So we care about that. because that's what's going to be used to compute the frog box and the range stat. And then from the high of the day to the close, call that the fade stat. We also measure from the open to the high of the day and call that the gain stat. So that gives you, right kind of from the open, if you know those statistics about your instrument, about your target, you have some kind of calibrated judgment about how far it could go on average. Well, if that's the average move, but we know something about the gap, we could now say if this was an exceptionally large gap, then I have a reason to believe that the move could be larger than the average gain from open to high, or average fail from open to low of the day. But I can use these as sort of like the initial stage 1 target. And if I call that leg 1, and I see price has moved out from the open as just going, and then doesn't even hesitate but keeps going, I already in my mind can say, look, there's a chance I can put a second position on here. Or if the move was such that it was a move fade and I have a kata 2 kind of action, I could either put a second position on here, or if this one got me out because I was protecting but it gave me a kata 2 right away, I can enter that next one with some conviction because the large gap is telling me that a move larger than the gain stat, and that seems to be the way it's going. Same thing to the downside. On the other hand, if I have a normal or smaller sized gap and this thing has moved quickly in the first 10, 15 minutes to a fail stat and now has started to reverse, it may be that I can put a MMRB on that and believe that what I have was just an orderly sell-off, and now it's like a fake 1 go 2. It hit the fail stat quickly, and now I could play from the low of the day. I can drop a range stat on and say I might be able to get that kind of a move. So now what I'm using is statistics to start framing the dimensions of a normal type day. I now have the reasonable parameters to use for what the kinds of moves there may be. So now I can talk about the opening range. Here's what we know about the opening range when we studied it with commodities and indexes and ETFs. And I didn't study it on currencies because I think it's different. But I can't give you evidence on that. So one of the things that we learned was that 90% of the time, the high of the day or low of the day occurs in the first hour. Oh man, is that any good? Because now I can go out 1 hour. I could just wait an hour and then look backwards and see, well, what is price doing? If it is doing this, I could say, and it's going up, I might be able to say, especially if it's like above the open, I can say, oh, well, that not only was the low of the day, it still is the low of the day. And now I'm an hour into this thing. I could ask myself, how far has this gone up the stack of a range stat? If that's truly the low of the day, and it is, and price is now right here, that's the move that I didn't get. How much move is left? Maybe I can get that. Or by the same token, if it was the high of the day and maybe did that, right? Well, 40% of the time, the open is within 10% of price of the high of the day or low of the day. Here's what I mean by that. Let's imagine a day that yesterday it closed here, and then today it opened here, and then all that thing did was just went straight up. At the end of the day, we would see one giant white candle with no tails. Check. And the open would have been here, and the close would have been there. So we take the high of the day and the low of the day, and we divide that into 100%, and we say, look, the bottom 10% is the bottom 10% of that range, and the upper 10% of that candle is the upper 10% of that. So what this says is that 2 days out of 5, you end up getting an opening that was here in that top 10%, and it did that. And maybe it was a small candle, I don't know, but it was still within the top 10. 90% of it, of the move, was in the other direction for that day. Or it opened here and then just did nothing but take off.
Mhm.
Well, what that means is that 2 days out of 5, you are regretting the fact that you waited a full hour to see what price was doing, when in retrospect you say, dude, that thing opened down here and has done nothing but go straight up. What was I doing? Yeah, well, 3 days out of 5, it may have opened here and went up and went down and went up and went down, went up, and then it closed with no change. And so waiting an hour didn't hurt you because you actually had a chance to get some of these intraday moves. Well, starting with this knowledge that that 90% of the time the high of the day or the low of the day was in the first hour, we created the slow frog, which waited an hour and then had some rules about when to get in. So we waited an hour and we said, look, we know that the instruments that we're trading have approximately 4 frog boxes to the range stat. So a frog quality number of 3 means that you had a range stat of 4 frog boxes. So what we said was, look, we've got to have a 2-to-1 reward to risk ratio. And what that means is, if I'm going long, and if I'm using a frog box as my risk, which we were at the time, because we thought we had to, I have to have 2 frog boxes up to the range stat of available room in order to justify the trade. So if it opened here and then monkeyed around and then it was moving up, and now we're an hour into the trade, we could take a look back and say, there was the low of the day. We haven't moved more than 2 frog boxes, so I could buy it anywhere in here, use a full frog box of risk, and still have reason to believe that I could have 2-to-1 if it moved a range stat to the upside. Check or hold? And then there were some things like, hey, what if this thing moved 3 frog boxes and then came back a frog box, and now 1 hour in is starting to fail? Okay, so now you can start seeing how complex these rules can get. Well, if at 1 hour the price was falling and there was a frog box of buffer to the upside, and I dropped the range stat and there was still 2-to-1, I could go short. So it had to do with what was price specifically doing what was price doing specifically at the 1 hour mark, and was there room above or below to make that move? So the whole idea was that the that the knowledge that 90% of the time the high or the low of the day is already made in the first hour gave us actionable information, especially when you combined it with things like the gap tells me which ones I ought to be trading because of big moves, and the range stat tells me what the magnitude of moves are. All of those things are possible. Okay. Well, oh, I didn't mean to do that, but I did it. So here we go. Well, I wonder if I can. Oh, it works the other way. Control Z works. Whew. That's a relief. So the frog system then had us start thinking in the following way. We said, well, what if instead of waiting a full hour, what if I just checked in at 30 minutes? And if it was one of those days where it opened and kept going, well, I could get in at the 30-minute mark instead of waiting for the 60-minute mark. And so that became the quick frog. Followed shortly thereafter by saying, what if I just took the open and hung a frog box on either side of it, and then as soon as it breached, I could just get long with the stop right here. And now, if it was one of those rocket ships, I could get in after giving up a frog box. So that became the leapfrog. It was ready to go right from the open. So then what we learned was, it's possible that instead of using a full frog box, I could start shaving that thing down to make smaller and smaller risk boxes that are manageable. And now I could actually get in on a minimum manageable risk box. And that turned out to be a really good idea. And here's why. So if this was the opening right here, if I could put a R10 minimum manageable risk box on that thing right from the open, now instead of waiting for a full frog box to get in and start entering here, I could enter here. And my risk would only be this much. And then I could get 2 units of reward compared to my initial risk at a time when, and I could have that locked in at a moment when price was telling me I now had a statistical advantage to start entering with a wider box. It turned out that if you did the mechanical rules, that you would get something like a 0.54 win rate, and you'd get an average win of about 0.7, and your average loss was minus 0.3. Well, that's pretty good. That's a coin flip that pays 2 to 1. And that's if you're making this entry up here. And we realized, look, in order to get a 0.7 win, this thing actually had to go 1.7 in our direction and then fail a full 1.0 so that you could get out at 0.7. That's how you get a 0.7 win from an entry. It had to go 1.7, come back 1, and then you could collect 0.7. Well, that felt really inefficient. So we started to study, how could I start improving once I get past my average win, how could I start ratcheting this up so that I give back less of an above average win? One line of research. The second line of research was, how could I reduce the size of these risk boxes so that I could get in sooner? Hey, if I could get in at 0.3, now at the time when I'm entering, I've already locked in 0.7, which was my average win on this trade. So I was in a position to start really improving. So that led us to the Hybrid Frog 2.0 and gave us ways to improve the frog rules. What that meant was we were also uh, entering and exiting much quicker. So this is where the ORs now come in. So the OR 60, I just told you some information about the 1 hour. There was also a guy who said, look at, he was only going to trade hourly charts. So here was the previous day, 1, 2, 3, 4, 5, 6. That was the previous day. And then today, the first hour would look like this. And all he did was put a band here, and he called that the OR 60, and said, look, if this thing breaks out of the first hour, if we just say, hey, that first hour is just the market makers and whatnot sorting out the overnight trade and whatever, there's still 5.5 hours of the day to go this way, and it's really 5 hours because the last 30 minutes is going to be crazy anyway. There's now 5 hours to make a move, and we'll just give you the first hour. So he did a study and found that if you at the first hour it had closed here, and then you just set this up as your initial risk, you say, all right, I'm long with a stop here, or I'm short with a stop here. That was a pretty simplified way to go. So that was some research that was reported in one of the trade journals, and we kind of validated that. At the same time, if you study Alexander Elder's triple screen system, one of the things that he did was 3 time frames: a weekly, a daily, and an hourly. And if the daily was your primary trading time frame, what he was looking for was a strong trend on a weekly, so something where the weekly bars were going up like that. And then on the daily, he wanted to see a retracement in which now these are the 5 bars of that next week. So there was a retracement like that. And he said, now what we're going to look for is the hourly resumption of the trend. He said, look, the primary trend was this. You had a manageable slight retracement, and now the hourly resumption was he would look for the next day an hourly breakout, which is this. So if this was the first hour and all these other things were true, like this might have had a weekly ADX greater than 25, or a daily ADX greater than some number. You can do the statistics on symbols to find out what the statistically significant strong trend is, which is in my daily report, by the way, for a number of things. But let's just call, so I converted everything to just daily charts. So it turns out that I think it's like 27 or something like that on the S&P currently. If you had a strong enough trend, that would override the little retracement that was happening. And then once you had evidence that the resumption was occurring, you could play the hourly breakout so you didn't get caught up in the little shenanigans. And one of the things that would quite often happen was you had like some kind of 5-day retracement, and now you met all the criteria for the weekly and the daily, and now here's the open, and then the next day would be perfect if it gapped down and then did something like this, and now you've set up your hourly chart and you said, all right, there's my initial risk, and here's my mechanical entry, 5 cents above, and now I can get long here, And then I can hope to see a multi-day move that started off really well from a breakout of the OR5. Well, Elder said more. What he really said was, we're just waiting for an hourly uptick. So you might have actually seen the daily retracement look like that. And then the next day, you might have had the first hour look like this, and then the second hour look like this, and the third hour look like that, and then the fourth hour look like this. And now Elder would say, look, all you got to do is just put a box around each hourly bar as it closes. And then if that opened higher, then you could get long, because it just took that long for the retracement to occur. And now you had hourly bar confirmation that it might be reversing intraday. So there's 3 different sources of interest in the OR60. Same research project, some guy had wrote about the OR5. Now, he was strictly a day trader. And what he said was, look, in his experience from the open, the first 5 minutes and maybe prices here, all he did was in the OR5 was put an open, or was put a bracket on here, and he said, that's going to be my risk, and whatever move it makes out of that bracket, I'm going to take it, and then that whole band is going to act like a buffer for the rest of the day. That it was normal that once it had broken out of that OR5 to the upside, that it would keep going higher. Now, it wasn't always like this. It might have been slow, and then back, and then recover. This might have been a support level that everything came back to. But he didn't invalidate the trade unless it had breached the entire OR5. So for a long while, as a 5-minute trader, I kind of used that as the guidance. Like, hey, just wait 5 minutes for the opening shenanigans, and then start picking up my typical routine. I combined that with the idea that 2 times out of 5, the open is within 10% of the high or low of the day anyway. So twice a week, that first move is just going to start and then just keep going. So what that led me to do was to refine the size of the risk box, not to the size of the OR5, but simply to use the MMRB as a standard unit of risk, regardless if it was from the open or if later in the day I saw a COTA 2 and I could put I put an MMRB here, and then buy a COTA 2 in here, or an emerging dragon up here. So I replaced the OR5 as the unit of risk with the MMRB. So, long story short, OR means opening range. I use OR3 quite often just to get in so that I don't overthink it, because I know how to get my risk out. In fact, this if the opening range, if the OR3 looks like this, you'll see me mark up those sniper charts, sniper trade of the day. I just, whatever that OR3 is, I just say, here's my trigger to go long, here's my trigger to go short. I feel like I'm front running the OR5, but then if I end up getting short here or long here, I will use the size of the MMRB as my unit of risk. Sometimes that OR3 is so volatile that it's bigger than the MMRB. Conversely, if that OR3 is so small that it is smaller than the MMRB, like a lot of times what I'll do is, if it's that small and it's a quiet day, I'll just go to the low and add an MMRB, and then wait to see it breach this level, because I want to see it go from the open. Really, actually, I should draw that from the open, and I'll just draw an MMRB up or an MMRB down. And then I'll make that trade. So the opening range is simply a way to have a mechanical reason to get in without trying to overthink it. Because you think about how many different people from all of the different time frames. If you were just there's guys that are making their annual rebalancing and then quarter rebalance and monthly rebalancing and weekly adjustment and daily whatever, and then all the pattern traders and then the day traders and then the news players and then all of these guys are they're all sending orders into the book to fill, and price behaves in a certain way. You cannot be serious if you think that you can study the characteristics of that 3-minute bar and determine what the composition of all these reasons to act are. Oh no, well I can use all the level 2. Shut up. Just don't try to understand it. Just try to act. And then my idea is, look, if I end up getting long, the only thing I have to do is be fast to get my risk out. As long as I can do that and get to a little wedge of no lose plus dinner for 2, that is more important than trying to understand all that. Because what if I could understand all that? Why did all these people put their orders in? That doesn't even help me with what happens after the 3-minute. I have to know something about, well, how much money are they putting it in how many tranches? Hey, this guy that's doing annual rebalancing, he's got 20 buckets of money that he plans to rotate in over the next 3 weeks. How am I going to figure that out? I can't know all that. So I would rather just concentrate on the behavior of getting an early entry, getting my risk out, and then just see what happens. I already know from the open that the size of the move, range stat plus and range stat minus, that tells me the size of the normal move of the day anyway. And from the open to a range stat, there's 10 MMRBs, and then there's 10 MMRBs that way. So I can just keep track of these little stair steps and just where am I inside the normal frame of a routine day. And if my risk is small and managed, it doesn't take much of a move for me to be able to get my risk out. And then it's a science project. So that's sort of the logic now of the OR3. Next question you asked was about
It was just the time frame, right? So
Yeah.
if you're
3
working-
versus
so-
30. Yep, 3 versus 30. So here's how I look at it. This is where I make my money. 30-minute charts. Just watch the hybrid swing trading portfolio management of the last 7 months. The first month was 200R. I just stopped counting because, I mean, what are you going to do? Believe me? I mean, you count them. I don't care. But I like the 3-minute. And there's reasons for that. Because on the 3-minute, my MMRB is an R10, which is 1/10 of a range stat. And in a 30-minute window, I get to make, I have 10 data points, which is 10 decision points. in the time that the 30-minute has one data point and one decision point. On the 30-minute bar, my risk box is normally about a frog box. Or I would say anywhere from 2 MMRBs to 3 MMRBs, and sometimes as much as 4 MMRBs, just based on what the characteristics of the trade is. Like sometimes that'll just be, hey, the PSAR is coming down, and then the PSAR flipped and is doing that, and it turns out that this is the size of the box that represents the shift between a downward trend to an upward trend. Hey, what if, whatever that size box is, what if I just made that 0.6 of a position sizing risk? Now I know that this is all noise, so I'm not going to make any decision to get out inside the noise because there's no information value. It's not until it violates the lowest PSAR that I have new information, which is a collapsing dragon. So if I can just set that equal to 0.6 for position sizing, I eliminate all of that second guessing inside the noise. There's no basis of making that judgment because you have noise for information. But I'm not taking a full 1 hour loss. All that means is, what if this was my full 1 hour loss, there has to be 2 full boxes to the upside, which means if this is 0.6, there's got to be 3 of those to the upside, because 3 times 0.6 is 1.8, and that's my 2-to-1 reward to risk. And that's easy to find those because you know the size of the range stat plus or minus, and if you're ending up making like if that's your 0.6, you know if you have an upside and a downside that's worked. Now, when you get a Z3 pinch and everything is so tightly compressed, a move in either direction gives you the smallest risk box and therefore the largest possible R multiple. So on the 30-minute bar, I'm making one decision per symbol every 30 minutes. It takes me 4 seconds to make a decision on a single, because I can see what it's doing. And now it's here. I can say, okay, done. There's my box. I'm going to go long here and short there. Now I get 30 minutes to wait. What's it going to do? If all it does is stay inside here, no change. It takes 1 second to do that. So I can track 30 symbols on 30 minutes at production level. Because on any individual bar, maybe there's only 5 of them that actually trigger. And oh, by the way, I'm using visual box trading, so I already have the orders in. It just goes in, and then I can manage it. So while I'm monkeying, or once I get all that done, in order to keep myself from fiddling around with that too much, either the really high performers or the underperformers, the extremes, 3 minute. Because now I'm using an R10, which might be a 10-cent risk box, whereas up here I might be using a 30-cent risk box, which means my position size could be 3 times as large. And in that same 30-minute move, I might be able to get 1, 2, or 3 positions in on very small risk boxes and capture inside 1 hour a 10R move on a 3-minute bar, whereas that might have been a half an hour or 1 hour on the 30-minute bar. So I can use the 30-minute bars for my production level and then cherry pick find the movers, and then drop down to 3-minute. Now my span of control on the 30-minute is about 30 symbols, and I can have as many as 30 open positions because they're all managed. The lines are drawn, and it just triggers. So I can do that in pretty quick. And then on the 3-minute, my maximum span of control is 4. Although lately, as I get older, I'm 65, I just like 1 or 2. I like 1 or 2 symbols and then try to get 4 positions on them.
So Ken, let me ask you.
But my days of managing 4 separate symbols with live positions with 10-cent risk is becoming a thing of the past, because I just pick 1 or 2 and go hard on that. Go ahead.
Well, I was going to ask, so for those of us, as we learn, would you recommend that? Because we're going to obviously have more opportunities
Yes.
on the 3 minutes.
Yes.
Okay.
And here's why. Because the 30-minute chart is a fast swing or a very slow day trade. 3-minute is a fast day trade. A 2-hour chart is a semi-fast swing. A daily chart is a swing trade. So if I'm on a 30-minute chart, am I slow day trading or am I fast swing trading? Yes. Yes, I am. Because it may have started off as a slow day trade. It may have opened here and then drifted down into here, and I got some kind of morning hook. And then 2 hours into the session, I had a chance to do this. And this thing just goes up and up and up and up. And here's the close. And now I'm in here and I'm holding, hey, there's plus 4R. Maybe I can put 3 in the bank and take 1R, reduce that position size by take off 2/3 or 4/5. So I might have had 600 shares on this one, and so I might have 100 shares on the wider stop, and use this money to fund 100 shares overnight. Whereas I have 600 shares intraday, I can risk the same amount of money, but it's now, because of the wider stop, it's only 100 shares to carry the overnight risk. Hey, next morning it starts doing this. Oh, bring in the other 500 shares and now make it an intraday trade on a 3-minute. So I could start off as a slow day, and I get 2 or 3 days in a row, like on what was it, Rivian and AI. That thing just wouldn't quit. So you have 3 days in a row like that. Hey, guess what? That just became a swing trade. Leave it alone. Or I might have had a swing trade that was moving up on daily bars, and I said, you know what? That thing is just working. Maybe I got my little 100 shares or 200 shares on it, and it's starting to go up again. That's the lowest risk day trade you ever had. I see a chance to do a COTA 2, put 500 shares on it or whatever, and now the swing trade is giving me day trading opportunities. I don't even have to do any research because I'm already researching it because it's a swing. So for me, the 3 and the 30 is connected to the 2-hour, to the daily, to the 3-day, to the 9-day. The 3-day and the 9-day are very slow swing trades. Wide stops can stay in those positions for months. I still have positions in on a 9-day swing trade from the turning point at the bottom of COVID, 90 or 100% ago. All paid for with intermediate trading that earned some money that let me roll it into longer term trades. So this array of times allows me to pick and choose where I want to focus. My focus right now, if I look at my total portfolios, is in my core positions, which are like monthly adjustments, and then swing trades and day trades. When I look at my capital, I have about 20% in here, and about 40% in here, and about 40% here. Because I don't even monkey around with that except once a month. And then the swing trades are working, and I can either reinforce them with day or I can hedge them with the day, and I don't have to change anything in that position. So my maximum overnight risk is going to be 60% of total portfolio anyway, and that's if all of the swing trade money is in the market. It could be as little as 20% because I've got the core positions in all the time. Maybe there's no swing trades working. Or maybe they net out to zero because some are long and some are short. But the maximum heat would be 40%. And then this is all liquid. And if I was worried, I could simply put a leveraged trade on with futures here so that my collection of swing and day is market neutral. No overnight risk. And then the next day the market opens and I can take the hedge off. And now these positions are still in and aren't going to get taxed. So to me, the idea, what makes this possible is the idea of fractal patterns. So it's the same decision being made on every time frame, and it's common symbols, so that I minimize my research effort to 50 or 60 symbols. And then the important thing is to compile a list of animals in the herd so that I have some broad indexes, I have some country indexes, I have some focused exchange traded funds, I have some large cap stocks, I have some focused companies like AI and Lemonade and Tesla, and I have 3 steel companies, 3 semiconductor companies, an energy company, a couple banks. So I have a stack of symbols that I'm pretty confident something is going to move today. And I'll just give everybody else can have all the other ones. All I need is some reliable movement. Some are up, some are down, some are just resting. So I can concentrate on that part of the herd that is moving and have a manageable set. And that seems to work for me.
Well, Ken, thanks. I mean, I know you took quite a bit of time, longer than you anticipated, and
Yeah,
whatever. For me, that was very helpful, and hopefully the other guys haven't heard it too many times.
Yeah. So so that was the ORs, and I wonder if it would. What's this? Oh no, it's not gonna. I thought I could Control Z my way back to the questions.
No, you got them. Those were really the questions.
Yeah. Let's see. Was there any? Yeah. So I get the mind map that I had in my mind before we started this was something like, and I'm not sure how to draw it yet, but it's sort of like on the 3-minute time window. I was thinking of kind of like, 30 minutes and daily and all that. So there's some things like the Kata 2 challenge that Griffin, those guys are doing specifically with EWZ and DIA, and there's a rule set associated with that, and that's the Kata 2. Well, yeah, the Kata 2 also works out here on these other swing frames too. So you got Kata 2s and owls and collapsing dragons and all that other stuff. And so they work on multiple time frames, and then sometimes you end up getting particular skills associated with a particular time frame. Like on the 3 minutes, you really have to wait for the opening 3 minutes to be done. And then in the last 30 minutes of the day, you got to make sure you have unleveraged your positions. And then you have moments in the day where the first 30 minutes behave a certain way, the last 30 minutes behave a certain way, and then the lunchtime has about 90 minutes. Now that leaves me about 2 hours and 2 hours in which I can actually see the morning move. That's 120 minutes. That's 40 3-minute bars. Right? That's only 12 10-minute bars. So the advantage of the 3-minute bar is I get more decision points and more fidelity about turning points. And then the lunch, it's possible to trade in here, but it's so narrow. That's where a lot of this chop is happening. That's chewing up Hamad. And then there's the afternoon trade, which is usually 1/2 the size of the morning trade. So if the morning trade is this big, and then the lunch trade stops in here, the afternoon trade could be half the size. So it's up, over, and back a half. So the net was here. Or it could have been plus a half, and now it looks like a huge day. So you get some kind of early morning move, and then the afternoon move could be either one of those, or maybe it just mucks around. So if you look at the market on 30-minute chunks, you can then drill down to the 3-minute chunks and do some good work inside there. And there's enough things to do. Yeah, but for me, the 30-minute bars feels like right now 30 minutes and probably like 5 days. You know, there's 13 30-minute bars. So 5 days times 13. That's 65 bar look back. That seems like plenty of time to see where the turning points are, to see, it's coming up into resistance and starting to fail, cut it. No, it's coming up into resistance and breaking through, buy it. That kind of stuff, right? Hey, it's starting to fail. Maybe, there's the support. That's my opportunity if it fails back to the same level. What if it only fails halfway and starts to reverse? Oh, well then I just got a low and a higher low. And now I have a kata 2 to play to here, and if it breaks out, off it goes. Lather, rinse, and repeat. That's all I do, is that support and resistance and those trade ranges, high of the day, low of the day, 5-day, 10-day high and low, 30-day window. What's the volatility? Is it pinched or it's expansive? And then pure pattern recognition and ruthless risk management. And that's all. All right, that's everything I got. I'm going to get this processed, and I just got to finish up the daily here real quick, and I'll see some of you guys in a few minutes. Yep. Take good care.
Thanks.
Yeah, Lou, if you send me those questions earlier, I can have it a little cleaner, and I can, instead of me scribbling everything, I can do it. So just send, if you get a chance.
You did great, but I'll try to do that in the future, though. Thank you.
That just helps me make a little better presentation for you. Hey, here's one that'll just make you sick. This is Ethereum, 3-minute charts. At the start of the lunch, it gave me a breakout signal, and it wasn't particularly fast getting it in, but that's the standard risk. And then the 2-hour battle drill, and 2 hours later, it's a 20-yard trade. It never looked back.
I'm glad you put this on, because I actually saw this. I didn't see it live. I went back and I saw this.
Yeah.
Were you triggered by an alert on the system to then go look at this?
Yeah.
Yeah. Okay.
Yeah. So as I'm going through the day, I just have those price boxes. Hey, what's a breakout that should get my attention? Just put the alert on it. Bing, I'll buy it. Oh, get my risk out. Oh, it's still going. Put a second position on. Now sharpen my knives. And that's the only thing I did intraday on 3 minutes was that, because why not?
Yeah.
Like, I
Wow.
get that first mover and 2 positions in, it's game on.
Yeah.
Meanwhile, the 30-minute things are just kind of grinding along, and then when I'm just waiting for this to do something, like between the second and third position was 30 minutes.
Mhm.
And so I'm just watching this thing for 30 minutes? No, I have the trailing stop on it, and then I go, while I'm looking at this, I can go manage the other ones and see if anything needs adjustment, and that takes a couple minutes.
So was there news on it, Ken? What caused, or I mean, I know you don't care, but
Now, there was some. I went actually when the market closed. I went back to look. There was some news announcements from the company that manages ETHE. So there may have been some kind of. I think they were doing like a rebalancing or something. So there were some position adjustments. So this might have been triggered by an ETHE rebalancing as opposed to an Ethereum, the actual crypto coin news.
gotcha.
But I just like, dude, I mean, you know,
Yeah,
by the time any news is there, the move is over. It's like, I don't know. And I really don't care.
yeah.
I
And
just-
what you say, Ken, earlier, just just all you do is look at it. That's it. That's all.
I don't know. I just look at it and just, I think about soccer and,
Oh, that's awesome.
so there we are. All right, guys. That's all I got for tonight.
Thanks.